Hello, friends. Today, we're diving into an incredible book that unlocks the secrets of how emotions and psychology shape our investment decisions. Inside the Investor's Brain by Richard L. Peterson takes us deep into the neuroscience of financial decision-making, revealing how fear, greed, overconfidence, and stress impact the way we trade and invest. This book isn't just theory, it's packed with real-world insights, backed by psychology and neuroscience, helping us understand why we make irrational choices in the market and how we can master our emotions to become better investors. If you've ever wondered why some traders stay calm under pressure while others panic sell, or why certain investors consistently outperform, this book has the answers. So, if you're serious about understanding the psychology behind smart investing, stick around till the end. And yes, don't forget to like, share, and subscribe for more such powerful insights. Let's get started. Markets on the mind. Investors love to believe that they can predict the market. But the truth? Markets are shaped by emotions, biases, and collective behavior more than pure logic. This chapter dives deep into how our minds influence our expectations and decisions, sometimes for the better, but often for the worse. Analysts and dartboards. Ever heard the saying that a monkey throwing darts can sometimes pick stocks better than professional analysts? Well, it's not just a joke. Studies have shown that many so-called experts struggle to outperform random chance. Why? Because analysts, just like regular investors, fall victim to biases. They get influenced by past trends, personal beliefs, and even their moods. But here's the real kicker. People trust analysts because they sound confident, not because they're always right. The human brain is wired to believe those who speak with certainty, even when the facts say otherwise. This is why you see so many expert predictions that completely miss the mark. Developing better expectations. So if analysts aren't as reliable as we think, how can investors develop better expectations? It starts with understanding that the market is unpredictable. Successful investors don't try to predict every move. They prepare for different scenarios. One key strategy? Recognizing your own biases. People tend to see patterns where none exist, overestimate their own knowledge, and let emotions cloud their judgment. The best investors train themselves to step back, analyze the situation objectively, and avoid making decisions based on fear or excitement. The wisdom of the collective. You might have heard of the wisdom of the crowd, the idea that a large group of people, collectively, can make surprisingly accurate predictions. Markets work in a similar way. When thousands or millions of investors act independently, their combined decisions create a market price that reflects available information. But there's a catch. This only works when people make decisions based on their own independent analysis. When investors start copying each other, like in a market bubble, this wisdom breaks down. Think of the dot-com crash or the 2008 financial crisis. When everyone blindly follows the crowd, markets become irrational and unpredictable. Meteorological anomalies, and other animal spirits. Believe it or not, weather and other external factors can actually influence investor behavior. Research has shown that people are more optimistic and willing to take risks on sunny days, while gloomy weather can make investors more cautious. This goes back to a concept called animal spirits, first introduced by economist John Maynard Keynes. It's the idea that human emotions, fear, greed, excitement, drive financial markets just as much as economic fundamentals. Traders often believe they're making rational choices, but their mood, the media, and even things like weather patterns can heavily impact their decisions. Sentiment. Market sentiment is the overall attitude of investors. Are they feeling bullish, optimistic, or bearish, pessimistic? Understanding sentiment is crucial because it can move markets even when fundamentals don't change. For example, if enough investors believe a stock will go up, they'll start buying it, which actually pushes the price higher. The opposite happens when fear takes over. Panic selling can cause prices to plummet, even if a company's fundamentals remain strong. Smart investors pay attention to sentiment, but don't get swept up in it. They recognize when emotions are driving the market and adjust their strategies accordingly. So, if you want to be a better investor, start by understanding yourself. Recognize when you're being influenced by external factors, question expert predictions, and always stay aware of market sentiment. Because in the end, investing isn't just about logic, It's about mastering your own mind. Chapter 2, Brain Basics. Understanding the brain is key to understanding how we make investment decisions. This chapter explores the neuroscience behind financial choices, how different parts of the brain process risk, reward, and emotions, and why some investors seem to have an edge over others. Damasio and the Iowa gambling task. Imagine you're sitting at a table with 4 decks of cards. Your goal? Win as much money as possible. Some decks offer big rewards, but also big losses, while others provide smaller, steady gains. This is the famous Iowa gambling task, a psychological experiment created by neuroscientist Antonio Damasio. It revealed something fascinating. People with healthy brain function start learning which decks are risky and shift towards safer choices. But individuals with damage to a specific part of the brain, the ventromedial prefrontal cortex, keep making poor decisions. They fail to recognize patterns, ignore losses, and chase rewards even when it's irrational. What does this mean for investors? It proves that emotions and decision-making are deeply connected. People who struggle to process emotions often make reckless financial choices, ignoring risk and overestimating rewards. The brain, structure and function. The brain isn't just one big decision-making machine. It has specialized areas that handle different tasks. Here's a quick breakdown of the key players in financial decision-making. Prefrontal cortex, the rational thinker. It helps with planning, impulse control, and logical reasoning. Amygdala, the emotional powerhouse. It processes fear, excitement, and stress, major factors in market movements. Striatum, the reward center. This part of the brain lights up when we win money, reinforcing risk-taking behavior. Hippocampus, the memory bank. It stores past experiences, which influence future financial decisions. The key takeaway? Investing isn't just about logic. It's a constant battle between emotions, past experiences, and rational thinking. The brain damage investor. Now, here's something shocking. Some investors with brain damage actually perform better in the market. Why? Because they don't experience fear the same way as others. Studies have shown that traders who suffer damage to the amygdala, the brain's fear center, are more willing to take calculated risks. They don't panic when markets crash, and they don't hesitate when opportunities arise. While fear is an essential survival tool, too much of it leads to hesitation, bad timing, and missed profits. But there's a balance. Completely removing fear can lead to reckless decisions. The best investors learn to control it, not eliminate it. Research methods. How do scientists study the investor's brain? They use cutting-edge tools like fMRI, functional magnetic resonance imaging, scans brain activity in real time while subjects make financial decisions. EEG, electroencephalography, measures electrical activity in the brain, showing how quickly investors react to information. Behavioral experiments. Tests like the Iowa gambling task reveal how people process risk and reward. These methods help researchers understand why people make irrational choices, why bubbles form, and why some investors consistently outperform others. Chapter 3, Origins of Mind. The way we think, feel, and make decisions in the market isn't just about logic. It's shaped by emotions, expectations, and even subconscious biases. This chapter uncovers the hidden mental processes that drive investment choices, often without us realizing it. Emotions and perceptions. Investors like to believe they make rational decisions, but emotions play a much bigger role than we admit. Fear, excitement, greed. These emotions shape how we perceive risk and reward. For example, when markets are booming, investors feel optimistic and see opportunities everywhere. But in a downturn, fear clouds judgment, making even good investments seem risky. The brain doesn't just process numbers, it interprets market movements through an emotional lens. Expectations and the comparator. Our minds are constantly making comparisons. When we expect a certain return on an investment and it falls short, we feel disappointment, even if we still made a profit. This happens because of a mental process called the comparator model. The brain compares reality to expectations. If the outcome is better than expected, we feel satisfied. If it's worse, we feel regret, even if the decision was logically sound. This is why investors struggle with taking profits too early or holding on to losses too long. Our expectations, not just the actual numbers, drive decision-making. Counterfactual comparisons. Ever regretted a decision because you imagined a better outcome? That's counterfactual thinking, comparing what actually happened to what could have happened. For example, if an investor sells a stock at a small profit, but later sees it double in value, they feel like they made a mistake, even though their original decision was reasonable. These mental what if scenarios distort judgment, making us overly cautious or too aggressive in future trades. Beliefs and expectations. The placebo effect. The placebo effect isn't just for medicine, it affects investing too. If we believe a stock is going to perform well, we tend to see positive signs everywhere. This confirmation bias makes us ignore red flags and overestimate our own abilities. The same happens with market trends. If everyone expects a bull market, optimism spreads and people invest more, actually driving prices up. But when sentiment turns negative, fear takes over, creating self-fulfilling market crashes. Making sense of the news. News plays a huge role in shaping market behavior. But here's the problem. Our brains don't process news objectively. Instead, we focus on headlines that confirm our existing beliefs, overreact to dramatic stories, ignore slow-building trends in favor of sudden events. Smart investors don't just react to the news. They analyze how the market is reacting to it. Sometimes, the biggest opportunities come from ignoring the panic and focusing on long-term fundamentals. Self-deception. One of the biggest dangers in investing is lying to ourselves. We convince ourselves that bad trades weren't our fault, that losses are temporary, or that we knew something would happen after it already did. This self-deception keeps us from learning from mistakes. The best investors are brutally honest with themselves, analyzing both wins and losses with a clear mind. Emotional defense mechanisms and motivated reasoning. When faced with uncomfortable truths, like a bad trade or a flawed strategy, our brains go into defense mode. We use motivated reasoning, selectively choosing facts that support what we want to believe. For example, an investor might blame the market instead of their own bad decision, ignore new data that contradicts their strategy, convince themselves that a loss isn't real until they sell. Recognizing these mental traps is key to becoming a better investor. The market doesn't care about our emotions. Only the best decisions win. Chapter 4. Neurochemistry. The brain isn't just a thinking machine. It's a complex chemical lab. Every decision, every emotion, and every risk you take in the market is influenced by brain chemicals called neurotransmitters. This chapter breaks down how these chemicals shape your financial choices, sometimes pushing you towards success, and other times leading to costly mistakes. Introducing the neurotransmitters. These tiny chemical messengers control how you feel, think, and react. And in the world of investing, they play a crucial role in risk-taking, patience, and emotional control. Serotonin, the mood regulator. Serotonin keeps you stable and calm. High serotonin levels make you patient and disciplined, key traits of a successful investor. But when serotonin drops, anxiety and impulsive behavior take over, leading to emotional trading and panic selling. Ever felt overconfident after a few wins, only to crash emotionally after a bad trade? That's serotonin fluctuating in real time. Dopamine, the reward chemical. Dopamine is what makes winning feel so good. When you score a big trade, your brain releases dopamine, reinforcing the behavior. The problem? Too much dopamine leads to overtrading and excessive risk-taking. It's why traders sometimes chase high-risk stocks, hoping for another dopamine hit. Successful investors learn to control dopamine, making rational decisions instead of chasing short-term thrills. Norepinephrine, the alertness booster. Norepinephrine sharpens focus and reaction time. It's what kicks in during market volatility, helping traders stay sharp. But high levels also increase stress, leading to overreaction and panic-driven decisions. Knowing when to step back and reset is key to avoiding burnout and making smart choices. Opiates, the painkillers. Opiates, naturally produced by the brain, help mask pain, both physical and emotional. When traders experience losses, opiates kick in to soften the emotional blow. But here's the danger. Too much reliance on this emotional cushion can make investors numb to risk, leading them to ignore red flags and keep making bad bets. Stress hormones, cortisol and adrenaline. Cortisol spikes in stressful situations, like market crashes. While it's useful for short-term survival, too much cortisol can cripple decision-making, making traders hesitant and overly cautious. On the flip side, adrenaline provides a rush of energy, helping traders react quickly. But prolonged exposure leads to exhaustion, emotional trading, and burnout. Caffeine, the investor's drug of choice. Caffeine boosts alertness by increasing dopamine and norepinephrine. That's why traders often rely on coffee during market hours. But there's a downside. Too much caffeine increases anxiety and makes traders overreact to small market fluctuations. The key is balance, staying alert without letting stress take over. GABA, acetylcholine, and omega-3 fatty acids. GABA, gamma-aminobutyric acid, calms the brain, preventing overthinking and panic, essential for disciplined investing. Acetylcholine enhances learning and memory, helping traders recall past market patterns and improve decision-making. Omega-3 fatty acids support brain function, reducing stress and improving cognitive performance. That's why a healthy diet isn't just good for your body, it's crucial for a sharp investment mind. Mental disorders. When brain chemistry goes out of balance, it affects investing decisions in a big way. Depression, low serotonin, leads to risk avoidance and missing good opportunities. Anxiety, high cortisol, creates overreaction and panic selling. Addiction, high dopamine dependency, triggers overtrading and gambling behavior. Understanding these imbalances helps investors recognize when emotions are clouding judgment. The neurochemistry of financial performance. Great investors aren't just good at analyzing data, they have neurochemical control. They manage stress, avoid dopamine-fueled risks, and keep serotonin stable for patience and discipline. This is why meditation, exercise, and even proper sleep can impact financial success. The brain performs best when chemistry is balanced. Serotonin and market bubbles. Ever wondered why people keep buying into a bubble, even when logic says it will burst? It's because serotonin and dopamine fuel herd behavior. Dopamine makes investors chase rewards. Everyone wants to be part of the rally. Serotonin increases confidence. People believe the trend will continue. By the time reality sets in, it's too late. The bubble bursts and panic selling begins. The best investors recognize these emotional cycles early and exit before the crash. Recreational drugs and alcohol. Substances like alcohol and drugs don't just affect personal life, they impact financial decision-making too. Alcohol lowers inhibition, leading to impulsive trades. Reduces memory recall, making it harder to learn from past mistakes. Even a small amount can alter judgment, which is why serious investors stay clear of it during trading hours. Cocaine overloads dopamine, creating overconfidence and excessive risk-taking. Destroys patience, leading to high-frequency gambling behavior instead of strategic investing. Many high-risk traders have fallen into this trap, chasing the thrill instead of long-term gains. Chapter 5. Intuition. Investing isn't just about numbers, charts, and data. It's also about intuition. That gut feeling, the instinct that tells you when something is right or wrong, plays a much bigger role in financial decisions than most people realize. But is intuition a superpower or a dangerous trap? This chapter breaks down how intuition works, when to trust it, and when to question it. Analysis and intuition. Investors often think of analysis and intuition as opposites. Either you rely on hard data or you trust your instincts. But the truth is, successful investors use both. Analysis is structured and logical. It looks at financial reports, earnings, and market trends. Intuition is fast and subconscious. It picks up on patterns and emotional signals that aren't obvious at first glance. Great investors don't ignore their gut feelings. Instead, they combine intuition with data to make well-rounded decisions. Investment practice. Just like any skill, intuition gets better with experience. A seasoned trader's gut feeling isn't random. It's built from thousands of past experiences. Their brain has stored patterns, signals, and small market cues that they might not even be consciously aware of. For example, if you've been investing for years, your gut might sense something is off in the market before you can fully explain why. That's because your brain is recognizing subtle shifts in price movements, investor sentiment, or past patterns, things you might not notice at a surface level. However, intuition without experience is just guesswork. New investors often mistake emotions like fear, greed, or excitement for intuition, leading to bad decisions. The key is to refine intuition through practice, learning from both wins and losses. What does your gut tell you? We often hear phrases like, trust your gut, or go with your instincts. But what is the gut actually telling us? If you feel uneasy about a trade, is it your intuition warning you? Or just fear of losing money? If you feel excited about a stock, is it a real opportunity or just FOMO, fear of missing out? The gut is powerful, but it's also influenced by emotions. Smart investors learn to separate emotional noise from real intuition. One way to test this is to write down your reasoning before making a trade. If your gut feeling aligns with logical analysis, it's probably reliable. If it's based on hype or panic, it's just emotion in disguise. Listening without thinking. Have you ever made a split-second decision that turned out to be right? That's intuition at work. The brain processes huge amounts of information subconsciously, spotting trends before the conscious mind catches up. This is why experienced traders sometimes just know when something isn't right. Their brain is recognizing small details, market momentum, order flow, sentiment shifts, before they can even put it into words. However, blindly following intuition can be dangerous. The trick is to listen but verify. Let intuition be the first signal, but always back it up with data. Intuition and emotion in investing. Intuition and emotion are closely linked, but they aren't the same thing. Good intuition is built over time, refined by experience and pattern recognition. Bad intuition is just raw emotion, fear, greed, excitement, tricking the brain into making impulsive decisions. Many investors mistake emotional reactions for intuition. They feel panic in a market dip and assume their gut is telling them to sell. In reality, it's just their brain reacting to stress. The best way to train intuition is to track decisions over time. When you trust your gut on a trade, write down why. Then review those decisions later to see if your instincts were right or just emotional. Emotional intelligence. Emotional intelligence, EQ, is the ability to recognize, understand, and control emotions, both your own and others. It's a crucial skill for investing because markets aren't driven by numbers alone. They're driven by humans' psychology. High EQ helps traders stay calm during market crashes. It allows them to read market sentiment and anticipate trends. It prevents impulsive decisions based on fear or greed. Traders with strong emotional intelligence don't just react to the market, they understand the emotions driving it. They recognize when hype is peaking or when fear is overblown, allowing them to make smarter moves. Subliminal emotion. Not all emotions are obvious. Some operate at a subliminal level, affecting decisions without us realizing it. For example, a recent loss can make an investor too cautious, even when a great opportunity appears. A recent win can make them overconfident, leading to reckless risk-taking. These subtle emotions shape decision-making in ways we don't always recognize. The key is awareness. By reflecting on past experiences and identifying hidden biases, investors can avoid emotional traps. Stirring the unconscious. The unconscious mind plays a massive role in investing. It's constantly processing past experiences, emotions, and external signals, guiding our instincts. That's why great traders rely on gut feelings, but they also train their unconscious mind by exposing it to quality information. They study past market cycles. They analyze both wins and losses. They track their emotional responses to trades. Over time, this sharpens intuition, turning the unconscious mind into a powerful investment tool. Chapter 6. Money and emotions. Money is never just about numbers. It's deeply tied to emotions. Every trade, every investment decision, every financial move is influenced by how we feel at that moment. Some emotions help us make smart choices, while others cloud our judgment and lead to bad decisions. This chapter dives into the emotional side of investing, how our feelings shape financial choices, how biases trick us, and how to manage emotions for better results. Emotional biases. We all like to think we make rational decisions, but the truth is our emotions constantly influence us, often without us realizing it. Emotional biases are mental shortcuts that distort our thinking. They make us see the market through the lens of fear, greed, regret, or overconfidence. Some common emotional biases in investing include loss aversion. The fear of losing money is twice as powerful as the joy of gaining money. This makes people hold on to losing stocks for too long or avoid risks even when they make sense. Overconfidence bias. Winning a few trades can make an investor feel invincible, leading to reckless risks. Herd mentality. The fear of missing out, FOMO, makes people blindly follow the crowd, buying at peaks and selling at bottoms. Confirmation bias. We tend to seek information that supports our beliefs and ignore anything that contradicts them. If we believe a stock will go up, we'll only focus on positive news, ignoring warning signs. Recognizing these biases is the first step to overcoming them. The best investors learn to separate emotions from logic before making decisions. The difference between positive and negative feelings. Not all emotions are bad for investing. Some emotions help us, while others hurt us. Positive feelings, confidence, excitement, optimism can give us the courage to take smart risks, but too much confidence leads to recklessness. Negative feelings, fear, regret, doubt, can help us avoid bad decisions, but too much fear leads to paralysis, missing out on great opportunities. The key is balance. A little fear keeps you cautious, but too much fear stops you from taking action. A little confidence helps you make bold moves, but too much confidence blinds you to risks. Smart investors don't let emotions control them. They use emotions as signals, but always confirm decisions with data and logic. Regret as a self-fulfilling prophecy. Regret is one of the most powerful emotions in investing. It happens when we sell too early and watch the stock go up, hold too long and watch the stock crash, miss out on a big opportunity. But here's the problem. Regret changes future decisions in a dangerous way. If someone regrets missing a stock rally, they might jump in too late next time, chasing the hype. If they regret a past loss, they might become too fearful and avoid good opportunities. Regret should be a teacher, not a trap. Instead of dwelling on past mistakes, successful investors analyze them, learn from them, and move on. An amicable divorce. This section introduces an important concept: separating emotions from money like a divorce. Many investors are emotionally attached to their stocks. They hold on to bad investments because they believe in them. But the market doesn't care about beliefs. It only responds to reality. Smart investors know when to cut ties and walk away. Just like a healthy divorce, sometimes you need to separate from a bad trade without emotional baggage. Holding on to losing stocks out of pride or hope can be devastating. Sadness and disgust. Two powerful emotions. Sadness and disgust also affect financial decisions. Sadness makes people more risk-averse. Studies show that when people are sad, they are more likely to accept lower returns just to feel safe. Disgust makes people want to get rid of things quickly, even if it means selling at a bad price. For example, after a financial loss, some traders panic sell just to remove the feeling of disgust from their portfolio. Emotions like these sneak into decision-making, leading to irrational moves. Recognizing them is key to avoiding mistakes. Fear and anger. Two of the strongest emotions in finance. Fear and anger drive some of the worst investment decisions. Fear makes people freeze. They hesitate, avoid risk, and sell too soon. When markets crash, fear spreads fast, and people panic sell at the worst possible time. Anger makes people overreact. After a loss, some traders double down on risky bets to get revenge on the market. This often leads to even bigger losses. Successful traders don't let fear and anger dictate their actions. They recognize the emotion, take a step back, and make decisions based on logic, not impulse. Projection bias. Projection bias is the tendency to assume the future will be like the present. It makes investors believe that if the market is going up, it will keep going up forever. If the market is crashing, it will never recover. This is why people buy at peaks and sell at bottoms. They assume whatever is happening right now will continue. But markets move in cycles. What goes up must correct, and what goes down eventually recovers. Great investors don't get trapped by short-term thinking. They zoom out and look at the bigger picture. Managing feelings. So, how do you control emotions in investing? 1. Recognize emotional triggers. Know what emotions influence you the most: fear, greed, regret, etc. 2. Create rules. Set clear rules for when to buy, sell, or hold so emotions don't take over in the heat of the moment. 3. Write down decisions. Before making a trade, write down why you're doing it. This helps separate logic from emotion. 4. Step away when emotional. Never trade when feeling extreme fear, excitement, or anger. Take a break, then reevaluate. 5. Learn from past mistakes. Keep a journal of past trades, analyzing what worked and what didn't. Mastering emotions is one of the biggest competitive advantages in investing. Those who control their feelings stay ahead of those who don't. Emotions drive the market more than numbers do. Fear, greed, regret, and confidence shape price movements every day. But the best investors understand their emotions, manage them, and use them to their advantage. The market rewards those who stay calm when others panic and act rationally when others act emotionally. Chapter 7. Excitement and Greed. Money triggers emotions like nothing else, and excitement and greed are two of the most powerful forces in the market. They fuel bull runs, create bubbles, and make investors chase risky bets. Greed can blind people to risk, while excitement makes them overconfident. This chapter explores how these emotions affect financial decision-making, why the brain craves rewards, and how to avoid getting caught in irrational market behavior. Brokers kindle irrational exuberance. Ever noticed how brokers, financial media, and even social media hype up stocks? There's a reason for that. Excitement sells. Brokers want you to trade more because they make money from commissions and fees. Financial media sensationalizes the market because dramatic headlines attract more viewers. Social media amplifies hype, turning normal stocks into must-buy opportunities overnight. This creates irrational exuberance when people get overly excited and push prices beyond reasonable levels. Stocks skyrocket not because of fundamentals, but because everyone is hyping them up. The key lesson? Step back, ignore the noise, and evaluate stocks based on data, not excitement. The anatomy of stock hype. Stock hype follows a predictable pattern. 1. A new stock or trend emerges. A company announces a new product, a sector gains attention, or a meme stock catches fire. 2. Media and influencers amplify the story. News outlets, analysts, and social media personalities push the narrative. 3. Early adopters jump in. Smart money moves first, buying before the hype spreads. 4. Retail investors pile in. FOMO kicks in, and thousands of traders rush to buy at inflated prices. 5. Reality hits. The hype fades, the stock corrects, and latecomers get burned. Think about meme stocks, crypto bubbles, or any hot IPO that soared and crashed. The hype cycle repeats over and over. Successful investors stay ahead of the cycle. They buy before the hype and exit before the crash. Greed, the basics. Greed is an instinct hardwired into our brains. It's what pushes us to chase bigger profits, take excessive risks, and ignore warning signs. Greed works like a dopamine addiction. The brain releases pleasure chemicals when we win, making us crave more. This is why traders who hit a winning streak often take bigger and riskier bets, believing the luck will continue. But the problem is, the market doesn't care about feelings. Greed blinds people to risk, making them hold on to stocks for too long or double down on bad trades. A successful investor understands this and knows when to take profits and walk away. The bias task. The bias task is a psychological experiment that shows how our brains overvalue potential gains and underestimate risks. In the experiment, participants were given choices between small guaranteed rewards and larger uncertain rewards. Most people chose the riskier option, believing they could win more, even when the odds were stacked against them. This is the same way people chase risky stocks and ignore safer investments. The takeaway? The brain is wired to prefer excitement over logic, which is why many traders fall into the greed trap. The nucleus accumbens. There's a specific part of the brain responsible for greed and excitement. It's called the nucleus accumbens. This is the pleasure center that activates when you see a stock going up and feel the urge to buy. You make a big profit and crave another win. You hear about others making money, triggering FOMO. This part of the brain lights up more during potential gains than actual wins, meaning the anticipation of profit excites us more than the profit itself. That's why many traders keep gambling, even after making money. They're chasing the thrill, not the result. Smart traders recognize this and don't let excitement override discipline. Excited about a good deal. Ever bought something on sale just because it was cheap? That same psychology applies to stocks. When a stock drops in price, many investors rush to buy, thinking they're getting a deal. But price alone doesn't make something valuable. Just because a stock is cheap doesn't mean it's a good investment. Example, people bought overvalued tech stocks in 2000, believing they were good deals after a small dip. They kept falling. During the 2008 crisis, investors bought real estate thinking it was cheap, but prices continued crashing. A good deal is only good if the fundamentals support it. Always check why a stock is dropping before jumping in. Improving biased decision-making. Since our brains naturally chase excitement and greed, how do we fix it? Here are a few ways. 1. Set clear exit rules. Decide in advance when to sell so emotions don't take over. 2. Limit exposure to hype. Avoid getting caught in media-fueled excitement by focusing on facts, not headlines. 3. Use historical data. Look at past bubbles and hype cycles to recognize patterns and avoid repeating mistakes. 4. Take profits regularly. Don't let greed make you hold on to a stock forever. Secure gains when possible. 5. Check the fundamentals. A stock should be fundamentally strong, not just popular. Greed in the markets. Greed isn't just an individual issue. It affects the entire market. It drives bubbles, crashes, and mass hysteria. Dot-com bubble, 1999 to 2000. Greed pushed internet stocks to insane levels before they collapsed. Housing bubble, 2008. Investors believed real estate could never go down until it did. Crypto boom, 2017 and 2021. People chased skyrocketing coins, thinking they'd never fall. Each time, greed made people ignore red flags. The best traders know that when everyone is greedy, it's time to be cautious. The market rewards discipline, patience, and logic, not impulsive buying based on hype. Learning to control excitement and resist greed is what separates long-term winners from short-term gamblers. Chapter 8. Overconfidence and hubris. Confidence is essential in trading, but there's a fine line between healthy confidence and destructive overconfidence. Many traders believe they have more control over the market than they actually do, leading to risky decisions, excessive trading, and major losses. This chapter dives into why overconfidence is so dangerous, how winning changes the brain, and what traders can do to stay grounded. The psychology of hubris. Hubris is more than just overconfidence. It's an inflated sense of self-importance. In trading, it happens when investors think they're smarter than the market, ignore risks because they believe they can't be wrong, double down on bad trades instead of admitting mistakes. History is full of examples where hubris led to financial disasters. Long-term capital management, LTCM, a hedge fund run by Nobel Prize winners, collapsed because they thought their models were flawless. The 2008 financial crisis. Bankers believed the housing market could never crash, leading to reckless lending and massive losses. Retail investors in meme stocks. Many held on to overhyped stocks, thinking they'd always go up, only to lose everything. The key takeaway? The market humbles everyone. No one is invincible. Overconfidence. Overconfidence makes traders believe they're better than they actually are, leading to 1. Excessive trading. Thinking every move is a winner, they make too many trades and rack up fees. 2. Ignoring diversification. They bet too much on a single stock, convinced they've made the perfect pick. 3. Holding on to losers too long. They refuse to admit they were wrong, hoping the stock will bounce back. Research shows that overconfident traders underperform disciplined investors. The best traders acknowledge that they will be wrong sometimes, and that's okay. Illusion of control. The illusion of control is when traders believe they have power over random market events. This mindset causes investors to overestimate their ability to predict market moves, believe past success guarantees future wins, think they can beat the market consistently. The reality? Markets are unpredictable. Even professionals can't always predict crashes, trends, or major news events. Smart traders focus on risk management, not perfect predictions. Winning changes the brain. Every time a trader wins, the brain releases dopamine, reinforcing the belief that they're skilled, even if luck played a major role. This can cause overconfidence. They think every future trade will be a success. Bigger and riskier bets. They crave the thrill of winning more. Recklessness. They stop analyzing trades carefully, assuming their instincts are enough. Winning rewires the brain to take more risks, which is why many traders blow up their accounts after a streak of success. The best traders stay level-headed even when they win. The neurochemistry of exploration. The brain's neurochemistry drives our decision-making. Traders with high dopamine levels are more likely to chase riskier trades for bigger rewards, jump into new market trends without full research, trade impulsively instead of sticking to a strategy. While risk-taking is necessary in trading, uncontrolled exploration leads to reckless behavior. The best traders balance risk with careful analysis. One who knows, Christian Siva-Jyothi. Christian Siva-Jyothi, a legendary trader, mastered the balance between confidence and humility. He knew when to take risks, but also when to cut losses. He never let winning streaks cloud his judgment. He constantly questioned his own decisions to avoid overconfidence. His success shows that true trading mastery isn't about believing you're always right. It's about knowing when you could be wrong. Confidence, the good. Not all confidence is bad. The right kind of confidence helps traders stick to their strategies even in tough times. Avoid emotional decision-making when the market is volatile. Take calculated risks instead of blind gambles. Good confidence is based on experience, discipline, and continuous learning, not just a lucky streak. Solutions. How to control overconfidence. To avoid falling into the overconfidence trap, traders should 1. Keep a trading journal. Track wins and losses to see patterns and avoid self-deception. 2. Use data, not instincts. Base decisions on research, not just gut feelings. 3. Set strict risk limits. Never risk too much on a single trade, no matter how confident you feel. 4. Regularly review mistakes. Admit errors and learn from them instead of blaming the market. 5. Stay humble. Even the best traders lose sometimes. Recognizing this keeps them cautious and disciplined. Chapter 9. Anxiety, fear, and nervousness. Fear is one of the most powerful emotions in trading. It keeps traders from taking necessary risks, causes panic selling, and fuels market crashes. But fear isn't just psychological, it's deeply wired into our brains. Understanding how fear impacts decision-making is crucial for every investor who wants to succeed in unpredictable markets. Climbing a wall of worry. Markets thrive on uncertainty. Every investor deals with a constant wall of worry, concerns about inflation, interest rates, recessions, political instability, and global events. Some traders freeze under pressure, afraid to make any move. Others become overly cautious, missing profitable opportunities. And then some panic sell, locking in losses instead of waiting for recovery. The best investors don't let fear dictate their actions. They accept uncertainty and focus on long-term trends instead of short-term noise. Dread in the MRI, how fear affects the brain. Neuroscientists have studied fear using MRI scans, and the results are fascinating. When investors anticipate a loss, the same brain regions that process physical pain light up. The fear of losing money is often stronger than the excitement of making money. This leads to irrational decisions. Traders hold on to losing positions too long, hoping the pain will go away. Understanding that fear is hardwired into the brain helps traders recognize when emotions are clouding their judgment. The best way to fight it? Stick to a well-defined strategy and follow the data, not emotions. Nature versus nurture. Are some traders naturally fearless? Some people seem to have ice in their veins. They stay calm in the face of market crashes and take big risks without hesitation. Is this something they're born with, or is it a learned skill? Research suggests that some individuals are genetically predisposed to handle risk better than others. However, experience and training also play a huge role. Seasoned traders learn to control their emotions over time. Fearless trading isn't about taking reckless risks. It's about managing fear effectively and making rational decisions even under pressure. It's all in your head. How perception shapes fear. Fear isn't always based on reality. It's often a perception issue. Investors fear market crashes, but historical data shows that markets always recover. They panic over bad news, even when the actual impact is minimal. It's that they hesitate to buy low because they fear prices will drop further, even though it's the best time to invest. Recognizing that fear is often irrational allows traders to take advantage of market overreactions instead of falling victim to them. Empathy gaps. Why we underestimate our future emotions. An empathy gap happens when we misjudge how we'll feel in the future. Traders believe they'll stay calm in a downturn, but when losses pile up, panic sets in. They think they'll hold on to a stock long term, but a small dip makes them sell too soon. They assume they'll buy during a crash, but fear keeps them on the sidelines. To combat this, traders need pre-planned strategies, rules that guide their actions before emotions take over. Pain relief. How traders escape fear. When fear takes over, traders look for quick fixes to relieve their anxiety. Some avoid checking their portfolios, hoping problems will go away. Others sell everything just to escape uncertainty. Many turn to confirmation bias, only listening to news that supports their fears. The solution? Data and discipline. Traders who follow a clear system and avoid emotional decision-making are far more successful. Investment lessons from fear. Fear isn't always bad. It can be a valuable teacher. Here's what traders can learn from it. 1. Fear signals risk, but risk creates opportunity. Instead of running from fear, traders should analyze whether it's justified or an overreaction. 2. Volatility is normal. Market swings happen, but the long-term trend is always upward. 3. Control what you can. No one can predict the market, but they can control their own reactions and strategies. Great traders don't eliminate fear. They learn to use it to their advantage. Of hurricanes, risk perceptions, and opportunity. Our brains aren't wired to assess financial risk logically. People fear plane crashes more than car accidents, even though cars are far deadlier. Investors panic over market dips, but ignore long-term gains. They overestimate low-probability disasters and underestimate common risks like poor money management. The best investors see opportunities where others see danger. When fear-driven investors sell in panic, smart traders buy at a discount. Chapter 10. Stress and Burnout. Trading isn't just about numbers. It's a mental and emotional battlefield. Stress is a constant companion for traders, and if not managed properly, it leads to burnout, bad decisions, and financial losses. Understanding how stress affects the brain and body is key to maintaining peak performance in the markets. Stress, the hidden enemy of traders. Stress is the body's natural response to uncertainty and risk, making it a major factor in trading. Market crashes, unexpected losses, and rapid price fluctuations trigger fight or flight responses. The brain releases stress hormones like cortisol and adrenaline, increasing heart rate and anxiety. Chronic stress impairs judgment, making traders more impulsive or overly cautious. Some stress is good. It keeps traders alert, but too much can lead to emotional trading and irrational decisions. Cramer on stress. A high-pressure profession. Jim Cramer, the famous financial commentator, embodies the stress-driven nature of investing. He thrives in high-pressure environments, constantly analyzing and reacting to market shifts. His energetic approach reflects how traders often feel, rushed, overwhelmed, and pressured to make quick decisions. But even seasoned professionals like Cramer need to balance stress with calm, strategic thinking to avoid burnout. The key takeaway? Stress is inevitable, but how you handle it determines your success. Choking for rupees. When stress paralyzes performance. Ever noticed how some traders excel under pressure while others crumble? Research shows that excessive stress can cause choking, freezing up when it matters most. This happens because stress hijacks the brain, making it harder to think clearly. Even experienced investors can make rookie mistakes when overwhelmed. The best traders train themselves to stay calm under pressure, just like elite athletes do in high-stakes moments. Which goes wrong? The brain or the brawn? In trading, mental endurance matters more than physical stamina. The brain's prefrontal cortex, responsible for rational thinking, shuts down under extreme stress. Meanwhile, the emotional brain, amygdala, takes over, causing knee-jerk reactions. This is why panicked selling happens in market crashes. Fear overrides logic. The lesson? Mental resilience is more important than raw intelligence in trading. Stress and trend perception, seeing patterns that aren't there. Stress doesn't just cloud judgment, it distorts how traders perceive market trends. Under stress, the brain starts seeing patterns that don't exist, leading to false predictions. Traders may overreact to small price movements, mistaking them for bigger trends. This creates a dangerous cycle of emotional trading, jumping in and out of positions irrationally. The solution? Step back, zoom out, and focus on long-term trends instead of reacting to every fluctuation. Neurochemistry of stress. What's happening in your brain? When stress hits, the brain floods with cortisol, the primary stress hormone. Short-term effects: increased alertness, faster reflexes, useful in quick decision-making. Long-term effects: memory issues, impulsivity, and emotional instability, terrible for trading. Excessive cortisol leads to tunnel vision, making traders focus too much on losses rather than opportunities. Controlling stress chemistry is key to staying level-headed in high-pressure situations. Biological effects of stress, when the body fights back. Chronic stress doesn't just affect the mind, it takes a toll on the body. High blood pressure, weakened immune system, and fatigue are common in traders facing constant pressure. Some traders develop insomnia, making them even more prone to bad decisions. Over time, stress leads to burnout, where the brain and body shut down completely. Taking breaks, exercising, and maintaining a balanced lifestyle aren't luxuries. They're necessities for long-term success. Adrenaline junkies, the thrill-seeking trader. Some traders thrive on stress, actively seeking high-risk situations. They chase volatile stocks, make massive bets, and love the rush of uncertainty. This addiction to excitement can be dangerous, leading to reckless decisions. Studies show that thrill-seeking traders have higher dopamine levels, making them prone to overtrading and gambling-like behavior. The best traders balance calculated risk-taking with emotional discipline, knowing when to push and when to pull back. Managing investment stress, how to stay cool under pressure. Successful traders have systems in place to manage stress effectively. 1. Follow a strategy. Having a pre-planned approach reduces emotional decision-making. 2. Take breaks. Not stepping away from screens helps reset the brain. 3. Limit information overload. Too much news fuels anxiety. 4. Practice mindfulness. Techniques like meditation and deep breathing improve focus. 5. Maintain perspective. One bad trade doesn't define your success. The goal isn't to eliminate stress, it's to control it so it doesn't control you. Chapter 11. Love of risk. Risk is at the heart of trading. Some traders thrive on it, while others fear it. But why are some people naturally drawn to risky investments, even when the odds are stacked against them? This chapter explores the psychology and neuroscience behind risk-taking, what makes gambling addictive, and how traders can strike the right balance between risk and reward. Why some traders love risk. Risk isn't just about making money. It's about the thrill, the excitement, and sometimes even the addiction to uncertainty. Studies show that high-risk traders have different brain chemistry than cautious investors. The brain's reward system lights up when taking risks, releasing dopamine, the same chemical responsible for pleasure and motivation. This is why some traders keep making risky bets, even after repeated losses. The rush of winning big feels so rewarding that it often overshadows logical decision-making. Knowing when to fold them, the art of walking away. One of the biggest mistakes traders make is holding on to bad trades for too long. The brain hates losing, leading to loss aversion, the tendency to avoid taking losses even when it's the best decision. Many traders double down on bad trades, hoping to recover instead of cutting their losses. Successful traders know when to say, enough is enough, and walk away from a bad deal. The lesson? Real winners aren't just those who win big, but those who know when to stop. Pathological gambling, when risk becomes an obsession. For some, trading isn't just a strategy, it becomes an addiction. Pathological gambling is a real psychological disorder where people become compulsively drawn to risk. Research shows that problem gamblers and high-risk traders share similar brain patterns. The same dopamine-driven feedback loop that fuels gambling addiction can also drive excessive trading. If you find yourself constantly chasing losses, feeling restless without trading, or taking irrational risks, it might be time to step back. The gambler's brain: why some traders take excessive risks. The brain is wired to seek rewards, and gambling-like behavior in trading taps into this primal instinct. The nucleus accumbens, the brain's reward center, lights up when anticipating a big win. High-risk traders often have lower serotonin levels, making them more impulsive. The illusion of control makes traders believe they have more influence over outcomes than they actually do. Understanding these biological triggers helps traders break free from emotional trading cycles. Ought to know better: why smart people still take dumb risks. Even the most intelligent traders fall into gambling-like behavior. Studies show that knowledge and intelligence don't always prevent bad decisions. The thrill of risk-taking can override logical reasoning, making even seasoned investors vulnerable to overconfidence. Some traders believe they're too experienced to fail, leading them to take bigger and riskier bets. The takeaway? Smart trading isn't about intelligence, it's about discipline. Reducing gambling-like behavior in trading. How can traders enjoy the thrill of the market without falling into destructive habits? 1. Set risk limits. Predetermine how much you're willing to lose on a trade. 2. Follow a system. Sticking to a strategy reduces emotional decision-making. 3. Take breaks. Stepping away from trading prevents impulsive behavior. 4. Keep emotions in check. If trading feels like gambling, it's time to reassess. The best traders don't chase excitement, they chase long-term success. Chapter 12: Personality Factors. Every trader has a unique personality, and that personality shapes how they make decisions in the market. Some traders are bold and take big risks, while others are cautious and prefer slow, steady gains. But how much of this is natural personality, and how much is influenced by experience? This chapter dives into the Big Five personality traits, how they relate to investing behavior, and what kind of traders tend to succeed in the long run. The Big Five: understanding personality in trading. Psychologists categorize human personality into 5 major traits, known as the Big Five. 1. Extroversion versus introversion, social energy and risk appetite. 2. Neuroticism versus emotional stability, handling stress and uncertainty. 3. Conscientiousness versus impulsiveness, planning versus acting on instinct. 4. Openness versus traditionalism, willingness to adapt to new strategies. 5. Agreeableness versus self-interest, collaborating versus acting independently. Each of these plays a major role in how traders approach risks, manage stress, and make decisions in the market. Extroversion versus introversion. Does social energy affect trading? Extroverts thrive on excitement and are often drawn to high-risk, high-reward trading. Introverts, on the other hand, prefer deep analysis and long-term strategies. Extroverted traders may jump into trades quickly without full analysis, while introverts may hesitate too much and miss out on opportunities. Balancing both is key to long-term success. Neuroticism versus emotional stability. Can you handle market stress? High neuroticism means a trader is prone to stress, anxiety, and fear of losses. Emotionally stable traders can keep their cool even during market crashes. Traders who score high on neuroticism often panic sell during downturns or make emotional decisions. Emotional stability is a huge advantage in the markets, allowing traders to stay disciplined. Conscientiousness versus impulsiveness, the discipline factor. Highly conscientious traders plan their trades, follow a system, and manage risk effectively. Impulsive traders often jump into trades based on emotions, news, or gut feelings. A structured approach leads to consistent long-term gains, while impulsiveness often results in overtrading and emotional decision-making. Openness versus traditionalism, adapting to market changes. Open-minded traders embrace new ideas, adapt quickly, and explore different strategies. Traditionalists prefer sticking to what has worked before and are slow to change. Markets are constantly evolving. Traders who fail to adapt often get left behind, while those who stay open to new strategies tend to outperform in changing market conditions. Agreeableness versus self-interest. Are you a lone wolf or a team player? Highly agreeable traders are collaborative and listen to others' insights. Self-interested traders prefer to make independent decisions. While collaboration can be valuable, successful traders need to think independently and not blindly follow market trends. The genetics of personality. Are traders born or made? Science suggests that personality traits are partly genetic. Some people are naturally risk takers, while others are more cautious. However, trading success isn't just about personality. It's about learning, adapting, and managing emotions. Even a naturally impulsive person can develop discipline with the right mindset and strategies. Investing personality. What kind of trader are you? Different personality types tend to gravitate toward different investment styles. High-risk traders, often extroverted, impulsive, and open to new experiences. They thrive in short-term trading but must control emotional impulses. Conservative investors, more conscientious and emotionally stable. They prefer long-term, low-risk investments. Balanced traders, a mix of both, taking calculated risks while maintaining discipline. Knowing your personality helps you choose the best trading strategy that matches your strengths and weaknesses. Neurotic investors, the dangers of emotional trading. Traders high in neuroticism often experience fear of missing out, FOMO, jumping into trades at the wrong time, panic selling, dumping stocks when markets drop, overtrading, making too many trades to compensate for losses. The best solution? Developing emotional resilience and sticking to a trading plan. Extroverted, open, and conscientious investors, the ideal traits for trading. Studies show that successful traders often share 3 key traits. 1. Extroversion, helps with quick decision-making and risk-taking. 2. Openness to experience, keeps traders adaptable to market changes. 3. Conscientiousness, ensures discipline and risk management. This combination allows traders to seize opportunities while staying in control of their decisions. Other personality research. What else matters in trading psychology? Beyond the Big Five, research highlights additional factors that influence trading behavior. Optimism versus pessimism. Optimists take more risks, while pessimists avoid them. Confidence versus overconfidence. Confidence is essential, but overconfidence leads to reckless trades. Patience versus impatience. Impatient traders chase quick gains, while patient traders wait for the right opportunities. Recognizing these traits in yourself can help you fine-tune your strategy and avoid common trading pitfalls. Chapter 13, Making Decisions. Every trader is constantly making decisions, whether to buy, sell, hold, or stay out of the market. But how do we actually make these decisions? Are they based on logic, or are emotions secretly pulling the strings? This chapter dives into the psychology and neuroscience of decision-making, uncovering how biases, probabilities, trust, and even brain chemistry shape the way we trade. Expected value and expected utility. Understanding risk and reward. Before making a trade, a rational investor should consider 2 things. 1. Expected value, EV, the mathematical expectation of a trade. It's calculated as EV equals probability of gain as gain amount, probability of loss, loss amount. If EV is positive, the trade makes sense. If it's negative, it doesn't. 2. Expected utility, EU. This is more personal. It considers how much you emotionally value potential gains and losses. A risk-averse person might avoid a trade even if the expected value is high because they fear losses more than they desire gains. Most traders think they're making rational, EV-based decisions, but in reality, their choices are often driven by emotions and biases, which is where things go wrong. The jackpot trap: why big wins can be dangerous. Have you ever hit a huge trade and suddenly felt invincible? That's the jackpot trap. When traders score a big win, their brains get flooded with dopamine, reinforcing risk-taking behavior. This overconfidence leads them to take bigger, riskier bets, often wiping out their gains. Winning big can distort their perception of probability, making them believe they're better than the market. It triggers addiction-like behavior, where they start chasing the high of another jackpot. A smart trader treats every trade as just one event in a long-term strategy, not a lottery ticket. Probability misjudgments: why we're bad at assessing risk. Humans are terrible at estimating probabilities. When trading, this often leads to overestimating rare events. People fear stock market crashes far more than they should. Underestimating common risks. Many traders ignore the slow bleed of frequent small losses. The hot hand fallacy: thinking a winning streak means they're more likely to win again. Markets are random in the short term, but traders often see patterns where none exist. Recognizing this bias helps avoid irrational trading mistakes. Vividness, imagination, and desire: the power of mental images. Your brain processes information in a visual and emotional way. That's why a shocking news story, like a financial crisis, feels more important than boring economic data. A friend's big win in crypto feels more real than statistics showing most traders lose money. Seeing a stock at an all-time high makes you feel like you're missing out, even if it's overvalued. The more vivid an event feels, the more influence it has on our decisions, even when it's not rational. Traders must learn to filter out emotional noise and focus on real data. Ambiguity and uncertainty: why we hate the unknown. Investors love certainty, but the market is full of ambiguity, unknown factors that make outcomes unpredictable. Risk is when we know the probabilities, e.g. rolling a dice. Ambiguity is when we don't, e.g. how a stock will react to earnings. Most traders are ambiguity averse. They avoid uncertain situations, even when they have a high reward potential. But those who can embrace uncertainty often outperform in the long run. Ambiguity in the markets: why uncertainty creates opportunity. Markets hate uncertainty, which is why stocks tend to drop on bad news or unclear events. But this also creates buying opportunities. A stock may crash due to fear and uncertainty, even if its fundamentals are strong. The best traders take advantage of panic selling instead of running with the crowd. Understanding market psychology helps investors make better decisions when others panic. Uncertainty is where the best opportunities lie, but only for those who can control their emotions. Neuroscience of ambiguity, risk and reward: how the brain reacts. Different areas of the brain respond to different types of uncertainty. The amygdala processes fear, triggering avoidance when we don't know what will happen. The prefrontal cortex tries to rationalize and make sense of uncertainty. The reward system releases dopamine when we take a risk and it pays off. This is why traders often fear losses more than they desire gains. Their brains are wired to avoid pain more than they seek reward. The possibility that you are overweight: cognitive bias in investing. Just like people can underestimate their weight, they can also misjudge their investment risks, overestimating their ability to pick stocks, underestimating their exposure to risk, ignoring small losses that add up over time. Good traders regularly reassess their portfolio to ensure they're not carrying more risk than they think. The trusting brain: why we believe what we shouldn't. Humans are wired to trust, which can be dangerous in trading. We often believe financial experts and influencers without questioning their biases, fall for market hype because it's repeated by trusted sources. Assume that because something worked in the past, it will work again. Smart traders question everything, relying on data over emotions. Neuroscience of the ultimatum game: the psychology of fairness. The ultimatum game is a famous experiment where one person is given money and must decide how to split it with another. If the other person rejects the offer, neither gets anything. Rationally, any money is better than nothing. But people reject unfair offers out of emotional anger, even if it means losing. In trading, this explains why investors often hold on to losing stocks because they feel they deserve to win. Make emotional decisions instead of logical ones. Revenge trade after a loss, trying to get back at the market. The market doesn't care about fairness. Only traders who control their emotions succeed. The trust hormone, how oxytocin affects investing. Oxytocin is called the trust hormone. It makes us feel connected and safe. But in investing, it can lead to over-trusting financial news and advisors, believing in narratives rather than real data, following the herd instead of making independent decisions. While trust is essential in life, in trading, it's important to stay skeptical and do independent research. Chapter 14, Framing Your Options. How you frame a decision completely changes how you perceive risk and reward. The same investment scenario can feel exciting or terrifying, depending on how it's presented. This chapter explores how framing shapes our investment choices, why we cling to losing trades, and how to rewire our thinking for better results. The disposition effect, why we sell winners and hold losers. Most traders make a critical mistake. They sell their winning stocks too soon and hold on to their losing stocks too long. This is called the disposition effect, and it's driven by a deep emotional bias. Selling a winner locks in a gain, making us feel smart. Holding a loser avoids admitting failure. But this mindset is completely backward. Smart investors let winners run and cut losers quickly. Think about it. Would you rather prune a tree by cutting off healthy branches while keeping the dying ones? No, but that's exactly what many traders do in their portfolios. A father-son stock sale, a lesson in bias. A real-world example of the disposition effect comes from a father and son. The father insisted on holding on to a sinking stock, convinced it would recover. The son, thinking more rationally, wanted to sell and cut losses. The father framed the loss as temporary and refused to act. Eventually, the stock collapsed completely, wiping out all value. This highlights a key lesson. Framing losses as temporary blinds us to reality. Sometimes, selling is the best decision, even if it feels painful. Teasing out the problem. Why we struggle to cut losses. There are 3 psychological traps that make selling losing stocks difficult. 1. Loss aversion. Losses feel twice as painful as gains feel good. 2. Endowment effect. We overvalue things just because we own them. 3. Sunk cost fallacy. We feel like we must hold on because we've already invested so much. But here's the truth. The market doesn't care what price you bought at. The only question is, would you buy this stock today at its current price? If not, it's time to sell. Framing risk. How perspective shapes decision-making. Risk isn't just about numbers. It's about perception. 2 investors can see the same situation completely differently based on how it's framed. For example, a stock that fell 50% could be seen as a bargain or a disaster. It depends on your perspective. A strategy with a 90% success rate sounds great, but if framed as a 10% failure rate, it feels risky. Successful traders frame risk logically, not emotionally. They focus on probabilities and expected outcomes, not just how something feels. A frame in the membrane, how mental filters affect trading. Every trader has a mental frame, a way of interpreting the market. But the problem is, these frames often lead us astray. Some traders frame investing as a game, making reckless bets. Others see it as war, leading to revenge trading. Many frame losses as personal failures, which clouds their judgment. To succeed, traders must reframe investing as a long-term strategy, where individual wins and losses matter less than overall performance. Holding losers. Double or nothing. Why we chase losses. Ever had a trade go bad and thought, if I just hold a little longer, it'll come back? That's the double or nothing trap. Here's what happens. Denial. Traders refuse to accept they were wrong. Hope. They wait, praying for a reversal. Desperation. Instead of cutting the loss, they double down, hoping to break even. Disaster. The stock crashes further, turning a small loss into a catastrophe. Smart traders cut losses and move on. The market doesn't care about your emotions. It rewards disciplined decision-making. Differences in aversion. Why some traders handle risk better. Not everyone reacts to losses the same way. Some traders panic at the first sign of trouble, while others remain calm and calculated. Why? Risk takers are more willing to accept short-term pain for long-term gains. Risk-averse traders panic easily and make emotional decisions. The best investors balance risk and reward. They know when to take bold moves and when to step back. Letting winners ride. The secret to long-term gains. One of the biggest mistakes traders make is selling winners too soon. The moment a stock makes a decent profit, they cash out, afraid of losing gains. But big money is made by letting winners run. The best performing stocks in history didn't just go up 10, they went up 100%, 500%, or even 1,000%. If you sell too soon, you miss out on compounding gains. Instead of selling outright, use a trailing stop loss to lock in profits while allowing room for growth. The key is to focus on long-term potential, not just short-term gains. Chapter 15, Loss Aversion, Why We Fear Losing More Than We Love Winning. Losses feel twice as painful as gains feel good. This psychological quirk makes traders panic sell in downturns, hold on to bad trades too long, and avoid risk even when the odds are in their favor. Understanding loss aversion is crucial because it influences almost every investment decision we make. Neuroscience of loss aversion. Why the brain hates losing now. The brain reacts to losses more intensely than it does to equivalent gains. Research shows that when people face financial losses, the amygdala, the brain's fear center, lights up. The ventromedial prefrontal cortex, responsible for rational thinking, shuts down. The result? Irrational panic, hesitation, and emotional decision-making. In simple terms, the brain treats losing money like a life-threatening situation, even when it's just a normal market fluctuation. This is why traders sell in fear when markets drop instead of thinking long-term. The equity premium puzzle, why people avoid stocks despite higher returns. Logically, stocks should be the best long-term investment. They outperform bonds and cash, but many investors avoid stocks because of short-term losses, a phenomenon called the equity premium puzzle. Stocks have higher returns over time, but they also have more short-term volatility. Because people fear short-term losses more than they value long-term gains, they avoid stocks and settle for lower returns in bonds or cash. The lesson? Successful investors ignore short-term noise and focus on long-term growth. The implied put option, how investors overpay for safety. Loss aversion leads investors to overpay for downside protection. Many traders buy put options or hedge excessively, reducing their gains just to avoid short-term pain. Think of it like buying expensive insurance for something unlikely to happen. It gives peace of mind but eats into long-term profits. Smart traders manage risk with diversification instead of excessive hedging. Accept that short-term losses are part of the game. Focus on big-picture growth instead of reacting emotionally to every dip. Overcoming loss aversion. Training your mind to accept risk. To become a better trader, you need to rewire your brain to handle losses rationally. Here's how. 1. Reframe losses as learning experiences. Instead of thinking, I lost money, think, I paid for a valuable lesson. 2. Use position sizing. Never risk more than you can emotionally handle. Smaller positions make losses feel less painful. 3. Focus on probabilities, not outcomes. A good trade doesn't always mean a win. What matters is making high probability bets over time. 4. Separate logic from emotion. When you feel fear creeping in, ask yourself, is this decision based on logic or emotion? The house money effect. Why we take more risks after winning. Ironically, while people fear losses too much, they also get reckless when ahead. This is called the house money effect. After big wins, traders feel invincible and start making high-risk bets. They act as if they're playing with free money, even though all money should be treated equally. This often leads to giving back all their gains in bad trades. The key is to treat every dollar the same, whether it's a recent profit or part of your original investment. Lessons from the Pope. Why certainty is an illusion. Even the most powerful leaders in history have been affected by loss aversion. The Pope once hesitated to sell church assets at a loss, even though it would have saved the Vatican money in the long run. The lesson? Even experts fall into emotional traps. The best investors recognize that losses are part of the process and act rationally, not emotionally. Comments from Soros, Tudor, and Kramer. Mastering Risk Like the Pros. George Soros, Paul Tudor Jones, and Jim Cramer all emphasize one thing: controlling emotions is more important than being right. Here's how they handle loss aversion. Soros: it's not whether you're right or wrong that matters. It's how much money you make when you're right and how much you lose when you're wrong. Tudor Jones uses a mental stop loss and cuts losses instantly when a trade doesn't work. Kramer focuses on risk-reward balance instead of obsessing over each trade. The common thread? The best traders don't avoid losses. They manage them effectively. Chapter 16, Time Discounting. Why we want instant rewards and struggle with patience. Imagine you have two choices. 1, $100 today. 2, $120 in a month. Most people would take the $100 today, even though waiting just a little longer would give them more money. This is called time discounting, our tendency to prefer immediate rewards over larger future gains. Traders and investors often fall into this trap, sacrificing long-term gains for short-term pleasure. This chapter explores why we struggle with patience, how our brains are wired for instant gratification, and how successful investors train themselves to think long-term. Get your hand out of the cookie jar. The struggle with impulse control. Picture a child staring at a cookie jar. If they wait 5 minutes, they get 2 cookies instead of 1. But the temptation is strong. Most kids grab the cookie immediately. The stock market works the same way. Impatient traders sell too early, missing out on long-term growth. Investors who resist the urge to take quick profits often end up making the most money. The market rewards those who wait. Impatient investors sell as soon as they see a small profit, missing the big move. Patient investors let their investments grow, benefiting from compounding and momentum. In trading, controlling impulses is the difference between average and exceptional returns. Brain basis of delayed gratification, the war between two brain systems. Your brain is fighting a constant battle between two forces. 1. The limbic system, impulsive brain, seeks instant rewards, activated when you crave fast money, junk food, or quick dopamine hits. 2. The prefrontal cortex, rational brain, thinks about long-term success, helps with planning, patience, and resisting temptation. When you see a stock making quick gains, your limbic system screams, "Take the profit now." But your prefrontal cortex knows, "If I hold, the real profits will come later." Successful traders train their rational brain to dominate their emotional brain. Chemical impulses. Dopamine's role in instant gratification. Dopamine is the brain's pleasure chemical. It's released when we win a bet, check our phone for notifications, see quick stock gains. Short-term traders often become addicted to the dopamine rush of making fast trades. This is why so many traders overtrade, constantly chasing short-term rewards instead of long-term growth. But real wealth isn't built on short bursts of dopamine. It comes from sticking to a strategy and letting compounding do its magic. Monkey business, the experiment that proves we hate waiting. Scientists ran an experiment on monkeys, testing their patience. The monkeys had 2 choices. 1, a small treat now. 2, a bigger treat if they waited. Most monkeys chose instant gratification, even when waiting just a little longer would have doubled their reward. Humans aren't much different. We get impatient when waiting for profits, which is why most people fail at long-term investing. But the smartest traders act differently. They train themselves to wait. Making a killing in the options pit. Why the best traders master delayed gratification? Professional traders in options markets understand time discounting better than anyone. They know most traders panic and close positions too early. Many investors are willing to take smaller gains today instead of bigger gains later. The biggest profits often come from waiting out volatility and sticking to the plan. Options traders who understand time discounting make strategic moves that exploit impatient investors. For example, they 1. Sell options to impatient traders who want quick payoffs. 2. Hold strong positions through volatility while others panic. 3. Capitalize on market inefficiencies created by emotional decision-making. This is how professionals profit from the impatience of others. How to overcome time discounting and think long-term. Want to make better financial decisions? Here's how to rewire your brain for patience. 1. Set clear investment goals. Have a defined time horizon, 1 year, 5 years, 10 years. Remind yourself why you're holding a position instead of acting emotionally. 2. Use a waiting period before selling. If you feel the urge to take profits, wait 24 hours before making a decision. This helps override impulsive emotional reactions. 3. Visualize long-term gains. Instead of focusing on short-term price movements, visualize what your portfolio will look like in 5 years. 4. Reward yourself for patience. Each time you successfully resist selling too early, acknowledge the win. Small rewards reinforce smart behavior. Improving self-control. The key to long-term success. Self-control isn't just about resisting temptation. It's about training your mind to make better decisions, especially in high-stakes environments like trading and investing. Imagine 2 traders. Trader A follows impulses, constantly checking charts and reacting emotionally. Trader B has a plan, sticks to it, and resists short-term temptations. Who do you think will win in the long run? Trader B every single time. But controlling impulses isn't easy. It requires rewiring your brain and developing habits that help you stay disciplined even when the market is unpredictable. How the best traders build self-control. 1. They remove temptation. Many traders set rules to limit impulsive behavior. For example, they might only check their portfolio once a day instead of watching every tick. Some even use automation, setting limit orders and sticking to their strategy instead of acting emotionally. 2. They train their patience. Instead of focusing on daily market fluctuations, successful traders focus on long-term trends. They remind themselves, I'm playing the long game. Patience is a skill, and the more you practice it, the stronger it gets. 3. They understand the science of willpower. Self-control isn't just about discipline. It's about managing your energy. Studies show that decision fatigue makes us more likely to act on impulse. This is why top traders pre-plan their moves instead of making decisions on the fly. In practice, how to strengthen self-control in trading. Want to improve your self-control? Here's how to start. 1. Create a trading plan and stick to it. Set clear entry and exit points before making a trade. This prevents emotional decisions in the heat of the moment. 2. Limit screen time. The more you watch price movements, the more tempted you are to react. Top traders don't stare at screens all day. They focus on strategy, research, and execution. 3. Use the 24-hour rule. If you feel the urge to make a big move, wait 24 hours before executing. This simple rule helps filter out emotional decisions from rational ones. 4. Reframe losses as learning opportunities. Instead of reacting emotionally, ask, what can I learn from this? This mindset keeps you focused on long-term improvement. Train your brain for patience. Practice delaying gratification in small ways, like waiting to check your phone or postponing a reward. The more you train self-control in everyday life, the easier it becomes in trading. Why self-control separates average traders from great traders. Weak self-control leads to impulsive decisions, panic selling, and emotional trading. Strong self-control leads to rational decision-making, long-term profits, and sticking to a winning strategy. The best traders don't let emotions dictate their trades. They have a system, they trust it, and they execute with discipline. If you can master self-control, you'll have an edge over 90% of traders who let emotions drive their decisions. Chapter 17, Herding. Herding is one of the most powerful psychological forces in financial markets. It's the tendency for people to follow the crowd, assuming that if everyone else is doing something, it must be right. But in investing, following the herd can be dangerous. Markets move in cycles. When too many people rush into a stock, it inflates a bubble. When panic sets in, everyone sells, often at the worst possible time. The best investors recognize herding behavior and know when to step away from the crowd. Herding. Herding happens because our brains are wired to seek safety in numbers. It's a survival instinct. In prehistoric times, sticking with the group meant protection from predators. But in modern financial markets, this instinct often backfires. Investors see others making money on a stock and feel pressured to jump in just in time for the rally to peak. When fear strikes, they sell in panic, just as the smart money starts buying. The key to avoiding this trap is recognizing when the herd is moving irrationally and having the confidence to think independently. Social proof. Social proof is the idea that we look to others for cues on how to behave, especially in uncertain situations. If everyone is buying a stock, it must be a good investment, right? Not necessarily. This is why market trends can accelerate so quickly. A few big investors buy in, others follow, and suddenly prices skyrocket, not because of fundamentals, but because of momentum fueled by crowd psychology. To resist social proof, investors need to ask, am I investing because I believe in this or because others are doing it? What happens if the crowd turns the other way? Social comparison. People naturally compare themselves to others. In investing, this can create pressure to keep up with peers. If your friends are making money in a hot stock, it's hard not to feel left out. But chasing returns based on comparison is a losing strategy. Every investor has different risk tolerance, goals, and time horizons. Following someone else's strategy without considering your own situation is a recipe for disaster. Instead of worrying about what others are doing, focus on your own strategy and long-term success. Ash and conformity. In a famous experiment, psychologist Solomon Asch showed that people will ignore obvious facts if the group disagrees. In his study, participants were asked to compare line lengths. When actors in the group intentionally gave the wrong answer, real participants often conformed, even when they knew it was wrong. This happens in markets all the time. Investors ignore red flags just because others are buying. But great investors like Warren Buffett succeed by thinking independently and making decisions based on logic, not crowd behavior. Information cascades. An information cascade happens when people assume the crowd knows something they don't, so they follow along without verifying the facts. Example, a new stock gets hyped up on social media. Early investors buy in. Prices rise, and more people jump in, not because they researched the stock, but because they assume others have. Eventually, reality catches up, and the bubble bursts. The solution? Do your own research. Never assume the crowd is right. Stanley Milgram and the shocking truth. Milgram's obedience experiment showed that people will follow authority figures even when it goes against their morals. In the study, participants were instructed to administer what they thought were real electric shocks to others. Most obeyed, despite hearing screams of pain. In investing, people often trust experts blindly, whether it's a celebrity investor, a financial news channel, or a social media guru. But even experts get it wrong. Always question authority and think critically before following financial advice. Nice clothes, fast cars, and fancy titles. We tend to trust people who look successful. A well-dressed trader in a luxury car must know what he's doing, right? Not always. Many scammers and overconfident traders use flashy appearances to lure in investors. The best investors focus on results, not appearances. Lesson? Don't judge expertise by status symbols. Judge it by long-term performance. The neuroscience of cooperation. Cooperation is essential in many areas of life, but in investing, it can lead to groupthink. Groupthink happens when teams or committees prioritize agreement over critical thinking. Dissenting voices get silenced, and bad decisions go unchallenged. Many financial bubbles were fueled by groupthink among analysts, executives, and regulators who ignored warning signs. Smart investors aren't afraid to question the consensus. Analysts' abuse of authority. Many investors rely on analyst ratings, but here's the truth. Analysts are often influenced by investment banks, corporate clients, and incentives. They rarely issue sell ratings because they don't want to upset companies they cover. Many analysts miss market crashes because they're too optimistic. Blindly trusting analysts without doing your own research is dangerous. The herding habit. Herding isn't just a one-time mistake. It's a habit that can be hard to break. Our brains crave certainty and belonging, making it difficult to go against the crowd. But breaking this habit is crucial. Some of the greatest trades in history were made by contrarians who went against the herd at key moments. Living the contrarian lifestyle. Contrarian investors don't blindly follow the crowd. Instead, they buy when others are fearful and sell when others are greedy. Think independently and question the mainstream narrative. Look for opportunities where the market is overreacting. This approach takes courage, but it can lead to big rewards. Advice for herd animals and trend followers. If you find yourself caught in herding behavior, here's how to break free. Stop chasing hot stocks just because everyone else is. Ignore market noise and focus on fundamentals. Develop your own strategy and stick to it, even when the crowd disagrees. Advice for investment committees. Investment committees are vulnerable to groupthink and herding. To make better decisions, encourage dissenting opinions. Base decisions on data, not emotions. Avoid making changes just because of short-term market trends. Chapter 18, Charting and Data Mining. Charting and data mining play a huge role in trading, but here's the truth. Markets are noisy and patterns don't always mean what they seem. Traders often fool themselves into seeing trends that don't actually exist. Some traders swear by technical analysis, studying charts and indicators to predict market moves. But is charting a real edge or just an illusion? Let's break it down. Artificial neural networks. With the rise of AI, many traders turn to artificial neural networks, complex computer models that analyze massive amounts of data to find market patterns. These systems can process millions of variables at lightning speed, spotting correlations humans would never notice. But there's a catch. Neural networks don't understand the market. They just detect patterns. Some of these patterns are random coincidences. Relying too much on AI models can lead to overconfidence and false predictions. AI-driven trading has its place, but it's not foolproof. Blindly trusting algorithms without questioning their logic is a dangerous game. Data mining and self-deception. Data mining is when traders search historical data for patterns. But the problem is, if you dig deep enough, you'll always find something. Let's say a trader analyzes 50 years of stock data and discovers that whenever it rains in New York, the S&P 500 goes up the next day. Is this a real market insight? No, it's just a random coincidence. The more data you analyze, the more false patterns you'll find. The key is knowing which patterns are real and which are just noise. Finding patterns in the noise. Humans are wired to find patterns. It's how our brains make sense of the world. But in the markets, this instinct can backfire. Example, a trader sees a stock making a head and shoulders pattern on a chart and assumes a crash is coming. But stocks don't follow magic shapes. Real market movements depend on fundamentals, news, and investor psychology. The lesson? Don't fall for random patterns. Focus on real market drivers. The trend and mean reversion biases in chart reading. Traders often fall into two psychological traps. 1. Trend bias, believing that a rising stock will keep rising forever. 2. Mean reversion bias, assuming a stock that has dropped must bounce back. Both can be dangerous. Sometimes trends continue, and sometimes stocks crash harder than expected. The best traders look at the bigger picture, not just historical price movements. Over-reliance on charts. Charts can be useful, but many traders rely on them too much. They think that because a stock followed a certain pattern before, it will do the same thing again. Reality check. Markets are dynamic. Just because a pattern worked in the past doesn't mean it will work tomorrow. Successful traders don't just follow charts. They understand market sentiment, fundamentals, and macroeconomic trends. The gambler's fallacy. This is one of the biggest psychological traps in trading. The gambler's fallacy is the belief that past outcomes affect future probabilities. Example, a trader sees a stock drop 5 days in a row and assumes it must go up tomorrow. But in reality, the stock doesn't owe you a win. Each day is independent of the last. Professional traders focus on probability and risk management, not superstitions. Irrational exuberance, called too early. Markets go through bubbles, periods of extreme optimism where prices soar beyond reason. The challenge? Timing the crash. Many traders spot a bubble but short too early, losing money before the market finally turns. Others assume that because prices are high, they must come down soon, but bubbles can last longer than expected. The key lesson? Being right isn't enough. Your timing has to be right too. The Suchow gambling task. This psychological experiment revealed something fascinating. People tend to prefer risky bets with short-term rewards, even if they lead to long-term losses. Traders often fall into this trap. They take high-risk trades for quick wins. Ignore the long-term impact of losses. Keep doubling down, thinking they'll make back their money. But the best traders focus on long-term gains, not short-term dopamine hits. The learned caudate. The caudate nucleus is a part of the brain linked to habit formation. Studies show that once traders form a habit, good or bad, it's hard to break. Example, if a trader wins money using a flawed strategy, their brain reinforces the habit, even if it was just luck. Later, when the strategy stops working, they keep using it, losing money. The takeaway? Always question your habits and adjust when the market changes. Patterns in earnings reports. Earnings reports can move stock prices, but traders often read too much into them. Some companies beat earnings expectations, but their stock still drops. Others miss expectations, but rally anyway. Why? Because markets price in expectations, not just results. It's not about whether earnings are good or bad, it's about whether they're better or worse than expected. Fooled by randomness. Nassim Taleb's book, Fooled by Randomness, highlights a brutal truth. A lot of what happens in the market is just luck. Some traders think they're geniuses after a winning streak, but was it skill or just randomness? Many successful traders eventually blow up because they don't recognize the role of luck in their wins. The smartest traders respect uncertainty and manage risk carefully. Chapter 19. Attention and memory. In trading, what we focus on and what we remember shapes our decisions. But here's the catch. Our memories are flawed and our attention is limited. Traders often misremember past events, fall for flashy distractions, and overestimate their ability to predict the future. Let's break down how attention and memory impact trading and what you can do about it. Terminal illness. When traders face a losing streak or a market crash, they sometimes develop a terminal illness mindset, believing that their trading career is over. A few bad trades don't define your future. Losses feel worse than wins because of loss aversion. Panic can make traders abandon solid strategies just because of short-term pain. The best traders detach emotionally from individual trades and focus on the bigger picture. Losses are part of the game. What matters is how you manage them. Representative returns. Traders often assume that if a stock or market has performed well in the past, it will continue to do so. This is a mental shortcut that can be misleading. Example, if a stock has delivered 20% returns for 5 years straight, many assume it will keep rising. But past performance is not a guarantee of future results. The market is cyclical. What goes up can come down. Relying on past returns without considering underlying fundamentals is dangerous. Smart investors analyze why a stock performed well before betting on its future. Fond memories. Traders often romanticize past wins and forget their mistakes. This selective memory leads to overconfidence. Example, a trader remembers a big win on a tech stock, but forgets the 2 times they lost money chasing the same trend. They assume they are good at trading tech stocks, but their actual win rate tells a different story. The best traders keep detailed trade journals to track wins, losses, and decision-making patterns. Honest self-reflection is key to improving. Beating the hindsight bias. Hindsight bias is when traders believe they knew it all along after an event has already happened. I knew Bitcoin would crash at 60K. It was obvious that stock was a bubble. Reality check. If it was so obvious, why didn't you act on it at the time? Markets are uncertain. It's easy to be a genius in hindsight. Traders need to recognize their past blind spots instead of rewriting history. Instead of saying, I knew it, ask yourself, what signals did I actually see and what did I miss? Attention deficit. Markets move fast and traders need to focus. But attention is a limited resource. Too many distractions lead to bad decisions. Social media, news, and constant notifications overload the brain. Many traders jump from strategy to strategy instead of mastering one. Short attention spans make traders react emotionally rather than think rationally. The best traders filter out noise and focus on what truly matters: fundamentals, trends, and risk management. Keep your eye on the pills. Studies show that medications for attention disorders like ADHD can impact risk-taking behavior. Some traders rely on stimulants like caffeine or prescription drugs to stay alert. Overuse of stimulants can lead to impulsive decisions and overtrading. The best traders focus on mental discipline, not artificial boosts. A clear, focused mind makes better decisions than an overstimulated one. What's in a name? Would you invest in a company just because it has a fancy name? Many traders do, without realizing it. Example, companies with names that sound powerful, futuristic, or high-tech tend to attract more investors, even if their fundamentals are weak. This is called the name bias. Smart traders look beyond the name and analyze the actual business. At China Prosperity Internet Holdings. This is a real-world example of how a name can drive investor interest. Many investors bought into companies with names that included words like China, prosperity, or internet, thinking they were part of a high-growth industry. But some of these companies were overhyped, poorly managed, or outright scams. The lesson? A great name doesn't mean a great investment. Always dig into the fundamentals. All that glitters. Flashy stocks, hot sectors, and trending investments can be misleading. Just because something is popular doesn't mean it's a good trade. Example, in every bull market, certain stocks become media darlings. Everyone rushes in, pushing prices higher. Then reality sets in, and the bubble bursts. The best traders resist FOMO, fear of missing out, and stick to sound strategies. Chapter 20, Age, Sex, and Culture. Every trader brings a unique psychological and emotional makeup to the markets, influenced by their age, gender, and cultural background. These factors shape risk tolerance, decision-making, and overall market behavior. Let's break down how these elements affect trading performance. Emotional memories. Our past experiences shape the way we react to market events. A trader who lived through the 2008 crash may always be cautious, fearing another collapse. Someone who made big profits in a bull market may believe markets always go up. These emotional memories influence our risk tolerance, sometimes leading to irrational decisions. Fear-based traders hesitate to take risks, even when the odds are in their favor. Overconfident traders ignore warning signs because they only remember past successes. The best traders learn to separate emotions from strategy, acknowledging past experiences, but not letting them dictate every decision. The female brain. Estrogen, emotion, and cooperation. Studies show that men and women approach risk differently. Women tend to be more cautious, better at risk management, and less prone to overtrading. Men, especially young ones, take more risks and trade more frequently, often leading to overconfidence. Estrogen plays a role in decision-making, social cooperation, and emotional control. Women are less likely to panic sell in market downturns. They often build portfolios with long-term stability rather than short-term speculation. This doesn't mean one approach is better, but it highlights why female investors often outperform men in long-term returns. Financial planning for divorcees. Divorce can have a huge financial impact, especially for those who weren't managing investments before. Many divorced individuals, especially women, suddenly find themselves handling investments alone. Emotional stress can lead to poor financial decisions, such as panic selling assets or making risky investments to recover losses. Key lessons. Educate yourself on financial planning before major life changes happen. Avoid emotionally driven financial decisions. Seek professional guidance if you're navigating investments post-divorce. Male overconfidence. Men, especially young traders, tend to overestimate their abilities. They trade more frequently, believing they can beat the market. They take bigger risks, sometimes without proper risk management. Studies show that male traders often have lower net returns than female traders because of overtrading, paying too many commissions, and making unnecessary trades. Ignoring risk, believing losses are temporary and will come back. The best traders, regardless of gender, acknowledge that confidence is good, but overconfidence is dangerous. Age. Age plays a huge role in risk tolerance and investment strategy. Younger investors take bigger risks because they have time to recover from losses. Older investors prioritize capital preservation and steady returns. But extremes in either direction can be risky. Young traders chasing high-risk investments can suffer huge losses. Older investors avoiding all risk might miss out on growth opportunities. A balanced strategy, adjusted over time, is key to long-term success. The Seattle Longitudinal Study of Adult Development. This study examined how cognitive abilities change with age, revealing key insights for traders. Younger traders process information faster but may lack experience. Older traders are slower in decision-making but excel in pattern recognition and risk assessment. This means young traders should seek mentorship from experienced investors. Older traders should leverage their experience while staying open to new strategies. In trading, wisdom often beats speed. Culture, East and West. Different cultures approach risk and investing differently. Western investors, US, Europe, tend to be more individualistic and aggressive in trading. Eastern investors, China, Japan, Korea, are often more collective, long-term focused, and cautious. For example, in the US, high-risk, high-reward investments like tech stocks and cryptocurrencies attract massive interest. In China, family and community influence investment decisions, leading to different market dynamics. Recognizing these cultural differences can give traders an edge, especially in global markets. Chinese risk takers. Despite their traditionally cautious approach, Chinese investors have become more speculative in recent years. The rise of high-frequency trading and speculative bubbles in China shows that risk appetite is shifting. Many retail investors in China follow trends aggressively, leading to market volatility. Lesson: understanding cultural shifts can help traders predict market movements. Biases among Chinese stock traders. Like all investors, Chinese traders are prone to psychological biases. Overconfidence. Many believe they can outsmart the market based on recent wins. Herd mentality. When one stock surges, millions rush in, driving up bubbles. Government influence. Unlike Western markets, government policies strongly impact stock performance. The key takeaway? Traders should recognize these biases and avoid getting caught in emotional cycles. Chapter 21, Emotion Management. Trading isn't just about numbers. It's about handling emotions under pressure. Markets are unpredictable, and if you let fear, greed, or frustration control you, you'll make impulsive mistakes. The best traders master emotional discipline, treating trading like a skill, not a game of luck. Do it for love, not money. Many traders enter the market chasing fast money, but this mindset often leads to burnout and failure. Successful traders don't trade just for money. They trade because they love the process. If you're only focused on profits, you'll panic during losses and overtrade when you win. Those who love the strategy, learning, and challenge of trading stay in the game longer. Money is the outcome, but passion for the craft is what keeps top traders moving forward. Money changes you. When traders start making serious money, their mindset shifts, sometimes for the worse. Winning traders feel powerful, which can lead to overconfidence and reckless decisions. Losing traders feel worthless, causing fear-based decisions that prevent them from recovering. Money amplifies emotions. If you lack self-awareness, success can make you reckless, and failure can make you quit. Traders need to detach their self-worth from their profits and losses. The market doesn't care about your feelings. It rewards discipline and patience. The best traders understand that money is a tool, not a measure of their value as a person. Emotional defenses. To survive in trading, you need mental strategies to handle stress, fear, and frustration. When losing, instead of revenge trading, analyze what went wrong calmly. When winning, Avoid overconfidence. Stick to your strategy, not emotions. When uncertain, take a step back. Rushing into trades under pressure leads to bad decisions. Emotional discipline separates great traders from gamblers. The pursuit of happiness. Many traders think they'll be happy once they make enough money, but the truth is different. Money solves financial problems, but it doesn't guarantee happiness. Some traders make millions yet feel unfulfilled because they never built a balanced life. Others trade to escape problems, which only makes things worse when losses happen. Happiness in trading comes from enjoying the learning process, setting realistic goals and appreciating progress, maintaining a life outside of trading. If trading is your only source of happiness, you're setting yourself up for emotional instability. Neuroplasticity. The brain can rewire itself based on repeated experiences. This means traders can train themselves to handle stress, make rational decisions, and develop discipline. If you panic sell every time the market drops, your brain reinforces fear-based reactions. If you stick to your strategy even during losses, you build emotional resilience. Neuroplasticity proves that trading discipline isn't just about willpower, it's about training your brain to react calmly under pressure. Chemical stabilizers. Neurochemicals like dopamine, serotonin, and cortisol affect trading decisions. Dopamine, the reward chemical, spikes when traders win, making them crave more risk. Cortisol, the stress hormone, increases after losses, causing fear-based decision-making. Serotonin, the mood stabilizer, helps traders stay calm and make rational choices. To maintain emotional stability, sleep well. Lack of sleep raises cortisol, leading to poor decisions. Exercise. Physical activity boosts serotonin, improving emotional control. Avoid caffeine overload. Too much spikes anxiety and impulsivity. Understanding your brain chemistry helps you manage emotions instead of letting them control your trades. Self-discipline. Discipline is the foundation of long-term success in trading. Stick to your strategy, even when emotions tell you otherwise. Avoid impulsive trades based on excitement or fear. Take breaks. Burnout leads to bad decisions. Great traders aren't the smartest, they're the most disciplined. Creating a decision journal. One of the best ways to improve emotional control is by keeping a trading journal. Write down every trade, what you were thinking, feeling, and why you entered. Review past trades, identify emotional mistakes, and improve decision-making. Over time, you'll see patterns in your emotional behavior and learn how to control them. A decision journal turns trading from emotional guesswork into a structured learning process. Chapter 22. Change techniques. Success in trading isn't just about technical skills. It's about adapting your mindset. The best traders constantly work on themselves, refining their emotional control, decision-making, and stress management. This chapter dives into practical techniques that help traders stay focused, overcome fear, and improve performance. Dealing with fearful and overconfident clients. Traders typically fall into two extremes. 1. Fearful traders hesitate, second-guess, and struggle to take risks, even when the setup is right. 2. Overconfident traders take excessive risks, convinced they can't lose. Both mindsets are dangerous. Fearful traders need to build confidence by sticking to a structured plan and reviewing past successes. Overconfident traders must accept that the market is unpredictable and that risk management is key to longevity. The best traders find a balance, calm, confident, but never reckless. Cognitive behavioral therapy and stress management. Cognitive behavioral therapy, CBT, is a powerful tool for rewiring the mind and controlling emotional reactions. Negative trading thoughts, I always lose, I'm not good enough, create stress and bad decisions. CBT helps traders reframe these thoughts into productive ones. Losses are part of the process. I can improve with discipline. Managing stress is critical because stress increases impulsivity, leading to rash decisions, narrows focus, causing traders to miss important market signals. Simple CBT techniques. Recognize negative thoughts and replace them with rational ones. Breathe deeply before making decisions to lower stress levels. Visualize success. Imagine executing trades calmly and following the strategy. Mastering mental habits can be as valuable as mastering technical analysis. Yoga, meditation, and lifestyle. Trading is a mental game, and the best traders treat their minds like athletes treat their bodies. Yoga improves focus and relaxation, reducing impulsive decisions. Meditation enhances emotional control, keeping traders calm in volatile markets. A healthy lifestyle, exercise, sleep, nutrition, sharpens thinking and reduces emotional swings. A trader's physical health directly impacts their trading performance. Simple stress reduction. When markets are moving fast, stress can skyrocket. Simple habits can help keep emotions in check. Take short breaks. Stepping away from the screen prevents emotional trading. Use a timer. Limit time spent analyzing charts to avoid overthinking. Write down emotions. Keeping a log of trading thoughts helps identify stress patterns. A calm mind makes better trades than a panicked one. Getting out of a slump. Every trader hits a losing streak at some point. The key is not letting it spiral into self-doubt. Instead of chasing losses, take a step back and analyze what's going wrong. Rebuild confidence by going back to basics, small, well-planned trades. Focus on process, not profits. When traders focus on executing their strategy correctly, the results follow. A slump is temporary, only if you adjust your mindset. Trading coaches. Many top traders work with coaches to refine their psychology. A coach doesn't give stock picks. They help traders identify emotional patterns that lead to bad trades, stay accountable to their strategies, develop better risk management habits. A trading coach can shortcut years of trial and error by providing direct feedback. Flavia Cymbalista and Denise Shull. Flavia Cymbalista and Denise Shull are pioneers in trading psychology, helping traders improve decision-making by understanding their emotions. Cymbalista focuses on instinctive decision-making, trusting gut feelings while balancing logic. Shull emphasizes emotional intelligence, acknowledging emotions rather than suppressing them. Their work proves that traders who manage emotions well tend to outperform those who ignore them. Modeling others. One of the best ways to improve is by studying successful traders. What habits do they have? How do they manage stress? What decision-making processes do they follow? By adopting the mindset of top traders, you can accelerate your own growth. Growing happier. Happiness in trading doesn't just come from winning trades. It comes from a sense of progress and mastery. Chasing money leads to frustration. Chasing improvement leads to long-term success. The happiest traders are the ones who enjoy learning and refining their skills every day. Neurofeedback. Neurofeedback trains the brain to stay in a peak state of focus and calmness. It uses real-time brainwave monitoring to show traders when they're in a stressed state. Over time, they learn to self-regulate emotions more effectively. This technology is used by elite athletes, military personnel, and top traders to enhance decision-making under pressure. Maintain learning goals. The best traders never stop learning. Instead of focusing only on how much money they're making, they focus on how much they're improving. Learning goals keep traders engaged, even when the market is tough. A trader committed to lifelong learning will always have an edge. Chapter 20, Behavioral Finance Investing. Investing isn't just about numbers. It's about how people behave in financial markets. This chapter explores how psychological factors shape investment decisions, create opportunities, and introduce risks. Harvesting risk premia. Risk premia refer to the extra returns investors earn for taking on additional risk. Some assets offer higher expected returns because they are riskier. For example, small-cap stocks, value stocks, and emerging markets. Behavioral finance suggests that investors often misjudge risk. They may overpay for safe assets and underpay for riskier but rewarding ones. Smart investors harvest risk premia by strategically taking on calculated risks. The goal is not to avoid risk, but to take risks that offer high potential rewards. Risk premia and expectations. The way investors perceive and react to risk plays a crucial role in portfolio performance. Some traders are too fearful and avoid high-risk, high-reward opportunities. Others chase risky assets at the wrong time, buying after a rally and selling after a crash. A disciplined investor understands: 1. Risk is necessary for long-term gains. 2. Managing expectations is key. Investing isn't about quick riches, but about compounding gains over time. Successful investing isn't just about picking the right assets, it's about having the right mindset. Value versus glamour. Markets tend to overvalue popular stocks, glamour stocks, and undervalue boring, overlooked stocks, value stocks. Glamour stocks, high-growth companies with exciting narratives, often become overpriced because of hype. Value stocks, low-priced companies with strong fundamentals, are often ignored but tend to outperform over time. Classic behavioral biases drive this pattern. Investors overestimate recent trends, pushing glamour stocks too high. Investors underestimate boring stocks, leading to bargains. The best investors look beyond the hype and focus on undervalued assets with strong long-term potential, momentum, size, and the optimal portfolio. Investors often debate how to structure the best portfolio. Momentum investing involves buying stocks that are already going up, assuming trends will continue. Size factor, investing focuses on small-cap stocks, which historically outperform large-cap stocks over time. The optimal portfolio balances different risk factors, momentum, value, size, while avoiding overexposure to any single bet. Behavioral finance explains that. Momentum works because investors are slow to react to new information. Size works because small companies are underfollowed and mispriced. Combining multiple factors helps reduce risk while maximizing returns. Building wealth requires a well-balanced, disciplined approach, not chasing hot stocks. Cheshk, buy on the rumor and sell on the news. Markets react to rumors before events actually happen. Investors tend to buy assets based on speculation. Prices rise leading up to an event. But when the actual news is announced, the price often drops as traders sell the news. This pattern repeats because traders overestimate the impact of news. Smart investors take profits before the hype fades. To avoid falling into this trap, look at long-term fundamentals, not just short-term news. Recognize when hype is inflating prices beyond reality. Limits to arbitrage. Arbitrage is profiting from price differences between markets, but in reality, there are limits to how efficiently this works. Behavioral biases, herding, fear, greed, create mispricings in markets. But traders with limited capital can't always exploit these mispricings. Even professional investors face restrictions on how much they can bet against irrational trends. Markets are not always rational, and sometimes mispricings persist longer than expected. The key lesson: just because something is overvalued doesn't mean it will crash right away. Timing matters. Behavioral finance fund performance. Funds that apply behavioral finance principles aim to exploit investor biases for higher returns. These funds look for undervalued assets, momentum opportunities, and market inefficiencies. They avoid common emotional mistakes like panic selling and overtrading. The takeaway? The best investors think differently from the crowd and profit from others' emotional mistakes. Behavioral investment products. Financial products are increasingly designed with investor psychology in mind. Target date funds automatically adjust risk levels based on an investor's age. Behavioral ETFs use AI to identify emotion-driven market inefficiencies. Hedging products help investors avoid panic-driven decisions during downturns. Understanding how investors think is now a major part of designing financial products. And that's a wrap on Inside the Investor's Brain by Richard L. Peterson. This book has given us a deep understanding of how our emotions, biases, and psychology influence every investment decision we make. From fear and greed to stress and overconfidence, we've explored the hidden forces that shape market behavior, and more importantly, how to control them to become smarter investors. If you found these insights valuable, make sure to like, share, and subscribe for more deep dives into powerful finance and trading books. And remember, mastering your mind is just as important as mastering the markets. Keep learning, keep growing, and I'll see you in the next one.